And that's when he realized his TFSA was a trap. Imagine thinking you're making a smart move with your savings, only to find out there's a hidden catch quietly eroding your investment returns. If you're investing or planning to, understanding market splits isn't just a nice to know. It can literally save you thousands or more. Today, we're diving deep into market splits, revealing the hidden dynamics behind stock splits, reverse splits, and everything that happens in between. Whether you're a beginner or have some experience, this knowledge can change how you view your portfolio and future investments. Before we jump into the nitty-gritty, let's set the scene. A market split might sound like financial jargon reserved for Wall Street insiders, but it's actually a fundamental concept impacting millions of investors worldwide. At its core, a market split is a corporate action where a company either divides its existing shares into multiple new shares or consolidates shares to adjust the stock's price. But why do companies do this? And how does that affect you as an investor? This is where common misconceptions arise. Many people assume stock splits are either meaningless or always positive, but the reality is far more nuanced. Take Netflix, for example. In recent years, Netflix's stock split garnered headlines and investor excitement. Their decision to perform a stock split in 2022 was seen as a move to make the share price more accessible to smaller investors, igniting a wave of buying. But what does that actually mean? A 2-for-1 stock split means every share you owned before the split became 2 shares after, having the price per share but doubling the number of shares. The company's overall market value remains the same, but the split often leads to increased liquidity and more trading activity as the lower price becomes accessible to a broader base. Now, contrast that with reverse stock splits, which don't get the same warm reception. A reverse stock split might be announced if a stock price falls too low, threatening the company's listing on major exchanges. Lucid Motors experienced this when their shares plummeted during volatile market conditions. They executed a 1-for-10 reverse split, consolidating every 10 shares into one. The stock price rose accordingly, but the total value to shareholders remained unchanged, at least in theory. In practice, this can be a red flag indicating trouble or a last resort to meet exchange requirements. This brings us to a key point. Not all splits signal growth or opportunity. Warren Buffett, widely regarded as one of the greatest investors, famously said that investors should ignore splits because they don't affect the intrinsic value of a company. Buffett's view pushes against the hype often surrounding splits, emphasizing that the company's fundamentals, like earnings, revenue, and strategic direction, matter much more than merely how many shares are available or the price per share. Yet the market's reaction to splits often paints a different picture, sometimes creating momentum or panic. To understand the practical effects, think of stock splits as changing the size of the pie slices without changing the actual size of the pie. Before the split, your slice was a certain size. After the split, you simply have more slices of the same pie. This is important, especially for retail investors who equate lower share prices with bargains, which isn't necessarily true. Remember, the market capitalization stays constant unless other market factors come into play. Statistics support this dynamic. A study analyzing S&P 500 companies over 2 decades found that while stock splits often trigger short-term increases in trading volume and sometimes a modest price bump, the long-term impact on stock performance is negligible. The immediate post-split enthusiasm can be attributed to increased accessibility for small investors and the signaling effect that a company is confident in its growth prospects. However, it's crucial not to mistake a split for an actual investment gain. Digging deeper into reverse stock splits uncovers some unsettling patterns. Companies undertaking reverse splits often face declining business performance or risk delisting. For instance, EZGO Technologies reversed their shares to regain Nasdaq compliance, a clear signal to shareholders that performance thresholds were at risk.